Hello, good morning. Welcome to Lecture 6. Today's topic is accounting for groups at the date of acquisition. And this chapter is part of consolidated accounts. Hope you all remember in our coursework 1 in the company's report, you have seen the financial statement of the company and financial statement of the groups. So we know how to prepare the financial statement of the company, individual company. This is easy, but we also need to prepare the financial statements of the groups. That means the parent company and the subsidiaries working under the parent company. So in this chapter, we will look at those, the issues mainly that we need to know how to prepare consolidated financial statements. So the main purpose of this chapter is to explain the reasons for preparing consolidated financial statement at the date of acquisition, why we need a consolidated financial statement, a financial statement for the group as a whole on the date of acquisition, and how we can prepare those statements. So in this chapter, in details, if we see, we will be able to prepare the consolidated financial statement if we understood all these things that we discuss in this chapter, and the ownership in the subsidiary can be whole, the group, the main company or the parent company can own the whole subsidiary or part of the subsidiary. So how the situation will differ. If a subsidiary is wholly owned or partly owned, then how we can prepare the consolidated financial statement. In case of partly owned, there would be an issue of non-controlling interest of the parent company. That means the parent company is controlling one part of the subsidiary and another part is controlling by someone else, other owners. That means the part that is not under control of the parent company is the non-controlling interest in the subsidiary. And also in that situation, we need to calculate or we need to find out the part of goodwill owned by parent and also by non-controlling interest. And also how can we adjust, or how can you find out fair value? What are the process? What are the considerations for determining fair value of the assets? And if there is any difference between the fair value and the book value of the asset, how we can adjust those in the books of accounts. And all these issues are explained in IFRS 3, 10, and 13. All right, so we will see the details of these in this chapter. So firstly, why a parent company or a company need to prepare a consolidated financial statement on the date of acquisition? So the reasons are prevent manipulation of the accounts, to provide a clear picture of the company to the investors, to the stakeholders. In some cases, a company can sell part of its company to uh, uh, another part and increase the amount of sales. So they can inflate the sales by selling within the groups. So that's why they need to recognize which part they own and which part not. and it will provide more meaningful and accurate earning per share, which is important for the investors to consider before investing. And also, it will provide the accurate return on capital employed for the company. So that in the company would be able to calculate accurate performance, determine accurate performance of the company. So that's why we need to clearly show how much of the company is owned by this company, this parent company, and how much is owned by someone else, and what is actual picture or financial position of this company in the subsidiaries. So definition of a group. So group depends on when a particular company own another small company or part of a small company. And the ownership can be direct and indirect. The control of the parent company over the subsidiary company can be direct and or indirect. So the direct ownership can be when the company has purchased the shares of the company, and indirect can be they can control the subsidiaries in other means, in other ways, like there is some sorts of controlling agreements. With the agreement, they can control the subsidiary, or because of some contractual relationship between the companies, they can control each other. So, what does group actually mean? Um, so, the the definition of control determines the ownership of the parent company over the subsidiaries. So the control actually mean, what does control mean? How a parent company can control or have control over subsidiaries can be based on the right to variable returns. So right to variable return means, so when a parent company invests in subsidiaries, the earnings or the profit or the return they will get from the subsidiary will differ, will not fixed. So if you get a fixed return from a company, then in that case you are not the controller. You are not the owner of the subsidiary. It is like you have provided some loan to the subsidiaries and you are getting interest. So if you want to be the owner, if you want to control, if you want to have um, the influence on the board of directors of the subsidiaries, you should have ownership. You should have control by purchasing shares, not providing loan. And if you purchase shares, you will have variable interest. Your interest or your return, your profit will differ, will changes. So this is what we call right to variable returns, not fixed return. Second factor, what does control mean? The control can be also by the ability of the parent company to influence the returns of the subsidiary. The subsidiary's profit, earnings, um, revenues can be significantly impacted by the investment decisions, influence of the parent company. For example, if the parent company withdraws its investment from the subsidiary, then the income or the return and revenues of the subsidiary can be impacted, can be changed, can be reduced. And the third factor is through power over investee. So the parent company will have power to influence, to control over the subsidiaries. For example, if the parent company has shares in the subsidiary, that means they will have the power in the board of directors. There will be a significant part of the board of directors, of the membership of the board of directors, would be from the parent company, through which they would be able to um, exercise their power in making decisions in the subsidiaries. So, and that's why so we have to prepare a consolidated financial statement immediately after acquisition, so that um, the financial statements of the companies and also the groups provide the clear picture to the investors so that they can make investment decisions appropriately. So as we define control, so the how much the control should be, that means how much the parent company should buy the shares of the subsidiary companies. Does it require 100%? No. The control can be any percentage. So usually when we say a parent company and subsidiary companies, um, usually we understood that the parent company has more than 50% of the voting rights in the subsidiary. That means more than 50% shares is owned by the parent company. More than 50% voting rights is owned by the parent company in the subsidiary. But it doesn't mean if you have less than 50%, you have no control. You may have control even if you have 20% or 30% shares in the subsidiary. This is also control. In that case, you may not be parent, you may be part of a non-controlling interest, but you have interest, you have control, though the control is less than 50%. So when control may exist if it is less than 50%. Agreement with other investors gives power over 50%. So you are, for example, um, you own 40% of the subsidiary company shares, but you have the significant relationship with other investors who invested in that subsidiary. You have agreement or relationship with other investors. That means if you can significant relationship with other investors who will hear your direction, who will act as you direct them, as you ask them, in that case you may have more than 50% control over the subsidiaries. So your control is 40% and another investor has say 20%. So um, so the 20%, the investor of 20% is also under your control. So in that case, your control in the subsidiary would be 60%, can be. Power over financial and operating policies by an agreement. So if you have a significant agreement, the agreement says whatever the company or the subsidiary produce, they have to sell to you. If you don't purchase, then they will sell to someone else. That means that all the operations of the subsidiary is controlled by you. Though you are not though you are not the owner of 100% share, but the contract that you made with that company indicates that you have full control if you have that kind of contract, or power to appoint or remove majority of the board of directors, member of the board of directors. If you have that right, that power, though you have less than 50% share, but you may have more power or significant control, power to cast the majority of the votes at the board meeting, right? Whoever in the boards, you have control all of on all of the members in the board. In that case, you have more power, you have significant power, though you are controlling less than 50% shares or voting rights. So in case of preparing the consolidated financial statement, we should know the fair values of the assets of the subsidiaries. So how we can calculate the fair value? What does fair value mean? We discussed fair value. Fair value usually means the market value. So in case of tangible asset, if the asset you can see, you can touch, which has physical existence, in that case, the fair value should be determined based on the market value. Market value, if you sell the assets now, what would be the value of the asset? And depreciated replacement cost if no market value is available. So if the asset has no market value, is not traded in the market now, in that case, if I want to purchase similar kind of asset, if I want to develop similar asset, if I want to replace the current asset, what I have now, what is the asset the subsidiary has, if I want to replace that, the existing asset, then what should be the cost? Then minus appropriate depreciation, then the available price should be considered as a fair value. But if the asset is, say, intangible, the asset that we can't see, we can't touch, which has no physical existence, like trademarks or copyright of an invention, what we can't see, the asset is non-existent, we can't see that. Goodwill, we can't see that. In that case, if there is a fair value, fair market value, if you can sell goodwill, if you can sell trademarks, so obviously there is a value. This is what we should consider. Or best arm's length estimate if no market value is available. Arm's length estimate means if there is two parties, independent parties, one buyer, one seller, who can independently buy that asset, what should be the price in the current market, right? That is arm's length estimate. So that should be considered as the fair value of an intangible asset. So like monetary assets and liabilities, in case of monetary, more specifically, monetary assets and liabilities, amount to be received or disbursed, like account receivable, accounts payable. These are monetary assets, right? Note payable, something like that, note receivable. So what's the money we are expecting to pay or we are expecting to receive should be considered as fair value. Or discounted if significant. If the value is significant, if there is any discounted value, discounted current value, current price, that can be considered as the fair value. Like if you are receiving the money in installments, so you are expecting to receive in, say, next 5 years, then what's the value today? Discounted value, present value. So in case of marketable securities, what's the market? It's marketable. Marketable means you can sell it to the market. You can. It has market. You can trade it. So what's the value in the market? Should be considered as um, fair value. Non-marketable, if there is no market for that assets or for that securities, in that case, estimated value based on the performance. Considering the performance of the company, that means company is not listed in the market. If the company is listed, that means it is marketable. There is market price of the shares. But if the company is not listed in any stock market, in that case, we have to estimate the value of the shares considering the performance of the company. So let's see an example so that we can understand better. Purchase method illustrated the Rose Group. So for example, on 1st of January 2020, Rose PLC acquired 100% of 10,000 £1 common shares in Tulip PLC for £1.50 per share. All right, so there is two companies here. So Rose is the parent company which purchased all the shares of the Tulip PLC. And how many shares the Tulip has? 10,000 shares. And the face value or the book value, face value of the shares, the written price of the shares is £1. But Rose purchased from Tulip those shares at 1.5 per share. Right, so if this is the case, then how can we prepare a consolidated financial statements? So let's see the individual picture in these areas, right? So what's the individual company's financial statement, company's financial position? Okay, this is what we can see here. So the Rose has non-current asset 20,000, Tulip has 11,000. Investment. So how much Rose company invested in Tulip? So they purchased 10,000 shares at 1.5. That means 1.5 multiplied by 10,000 is 15,000. So the Rose company purchased 10,000 shares at 1.5. That means total investment in Tulip is 15,000. So this is investment for Rose company. And non-current asset, these are non-current assets. And current assets, 8,000 for Rose and Tulip, 3,000. So the net asset for Rose is 43,000, and net assets, the total assets for Tulip is 14,000. And share capital, Rose Companies has 16,000 share capital and Tulip has 10,000 share capital. Remember, 10,000 share capital, that is 10,000 share, and one share is £1. So 10,000 multiplied by 1 is 10,000 share capital for Tulip. And the retained earnings, Rose has £27,000 of retained earnings and Tulip has 14,000 retained earnings. All right. So how can we prepare a combined consolidated financial statement for these two companies together, parent company and subsidiary company? How can we make it a combined statement? So in case of combined, this is what the group financial picture you can see here. This is the group. So if we want to prepare a group financial statement, what we have to do, we have to calculate this figure, right? This is step 1 that we will see in the next slide. Step 1, we have to calculate this figure. Okay, this 1,000. How can we get this 1,000 figure? All right. So this is actually what is the asset available in Tulip. You can see if you consider the asset, it's 14,000, or if we consider the share capital, also we can, that is 10,000 and 4,000, that is 14,000. Okay, but how much we invested for the whole company? We purchased the whole Tulip, remember. So for whole Tulip, we have paid 15,000. But how much asset the company has? Tulip has 14,000 asset. So we paid 1,000 more. And why we paid 1,000 more? So if we pay more than the asset that subsidiary has, that means the company has goodwill, has recognition in the market. That's why we paid more. So the money that we paid in excess of the asset the company has now is actually goodwill that we need to recognize in the group's financial statement. All right, so this is what the goodwill figure. So if we combine the groups, so this is 20,000 and 11,000, these two assets come together, this is 31,000. All right, and the additional figure, right, that we invested, that is the goodwill of the group of the Tulip, that should come in the group's financial statement, that is 1,000. So the 14,000 minus 15,000, so that is extra 1,000 positive. We paid more. This is goodwill. So 1,000. And non-current asset add together, this is 11,000. 8,000 and 3,000, 11,000. So altogether 43,000, and you can see 43,000 here because the company purchased 100%. And the share capital 16,000 and retained earnings 27,000. So altogether 43,000. This is the group's picture, right? This is the group financial statement. So how this figure came, we can see how in the next step, on the next slide we can show, but this is what I showed here. So this is what the 1,000, right? So the amount that you invested is 15,000, right? And in the subsidiaries, they calculate based on capital. So subsidiary share of capital, you purchase 100% of the capital, that is 10,000 capital, 100%, that is 10,000. And retained earnings is also part of capital. So you purchased 4,000 times 100%, that is 4,000. That means 14,000 you are receiving, right, from the subsidiary, but you have provided, you have given 15,000, you have invested 15,000. So the money that you paid extra is 1,000, right? That is for goodwill. Why you paid more? Because of goodwill. The company has recognition in the market. The company is profit earning company. That's why you are paying more. All right. And yeah, in case of what we said in the second step is calculating the total asset of the group financial statements. So non-current asset 20,000 and 11,000, that is 31,000. And current asset, this is also given 8,000 plus 3,000. And goodwill that we have calculated from step 1, that is 1,000. So altogether 43,000. All right. And step 3 is simply the share capital of the parent company only is 16,000, and parent only, again, retained earnings, that is 27,000, and altogether 43,000. All right. So this is all about if the company purchase 100%, that is, there is no non-controlling interest. All right. 100% control, 100% share if the ownership is 100% of the parent company over subsidiary company. So in the next part of the video, we will see if the company purchase less than 50%, less than 100%. That is, if the company has non-controlling interest, then how can we prepare a consolidated financial statement? So see you in the next part of the video.